Cast is now starting. All attendees are in listen-only mode.
Hello everyone, my name is Salvatore Pinizzotto. I am the Secretary General of the International Rubber Study Group. Let me thank our colleague and friend Ramon Salinas, Executive Director and CEO at the International Institute of Synthetic Rubber Producers, for accepting the invitation from the IRSG Secretariat to jointly organize this important webinar. A warm welcome goes to all ISG and IISRP industry members and governments representatives that are joining us today from all over the world. We are getting closer to the end of a very complicated year for the world economy and for all of us. That has not spared the whole rubber value chain. During the first half of this year, the lockdown imposed by countries around the world in the attempt to contain the coronavirus pandemic has brought to a halt manufacturing activities. Automotive production and sales dropped to unprecedented low levels, negatively impacting the tire industry, and many people have lost their jobs. On the other hand, the pandemic has prompted an increase in the demand of rubber gloves for the healthcare system, benefiting natural latex and nitrile latex producers. A growth that might continue in the future as awareness towards health and personal hygiene are likely to remain prevalent as the general society is embracing the new normal. Today, we can look at the near future with a dose of optimism. The progress made by science in the field of vaccination will support a progressive return to normality already in 2021. During this hour that we spent together, we intend to discuss the challenges faced by synthetic rubber industry during the pandemic, providing also a view on the prospects of these important sectors in the years ahead. Before giving the floor to our moderators and speakers, I would like to provide you some housekeeping items to make sure that we have the best experience possible. We are going to have two presentations, one on global economic overview and one more specific on the synthetic rubber sector. First, I would like to introduce the session moderators, Dr. Lekshmi Nair. She is my colleague, and she is the head of economics and statistics at the International Rubber Study Group, and Roxanna Petrovic, the director of general programs at IISRP. First, you are listening in using your computer's speaker system by default. If you prefer to join over the phone, just select telephone in the audio box and the dial-in information will be displayed. You are muted by default, and we will keep this feature as it is to provide an organized session to avoid the background noise and interruptions during the presentation. If you have a question for our speakers, please feel free to send them through the question box in the control panel. You may send in your questions at any time, and we will be answering questions at the end of the session. Also, you can download the presentations in PDF from the handouts box in your control panel. I think this is all from me by now, and I leave the microphone to Roxanna.
Thank you, Salvatore. Hello, everyone. Now it's my turn to introduce our first speaker, Mr. Tom Rogers. Tom is head of macroeconomic consulting, Asia for Oxford Economics based in Singapore. Tom leads the macroeconomic consulting work across the Asian region, encompassing a range of different sectors and analytical tools and approaches. Since arriving in Singapore at the start of 2019, Tom has led projects across the financial services, transport, government, and consumer goods. Tom is a regular speaker in media to regional industry bodies and the Asian leadership teams of major multinationals operating across the continent. Prior to relocating to Singapore, Tom was part of the Europe and Middle East Macroeconomic Consulting Division, where he also led consulting projects across a range of sectors and traveled regularly to key Middle Eastern economies. Before joining Oxford Economics in 2010, Tom was economic advisor at HM Treasury and the Foreign and Commonwealth Office for a total of 9 years. Tom graduated from Warwick University with a Bachelor of Science in Economics and Politics and took a career break from the civil service to complete a Master of Science in Economics at Southampton University. Welcome, Tom, to our webinar session. We are very excited having you here today. And from this point, our speaker will take control over the presentation. Here we go.
Okay, thanks very much, Roxanna.
Right.
Let's,
perfect. We can see your presentation.
Oh, you can. Brilliant.
Yes.
Okay.
Perfect.
Wonderful. Okay. And it's flicking back and forth. You can see.
It works. Thank you.
Yeah, perfect. Thank you very much. Thank you very much, Roxanna, and thank you, Salvatore, and thanks to the International Rubber Study Group for the opportunity to present our views today. My name is Tom Rogers, as Roxanna said, and I lead our macroeconomic consulting work here in Asia Pacific, based in our Singapore office. Just a brief introduction to Oxford Economics for those of you who haven't worked with us before. We were founded in 1981 as a joint venture between some postgrad students at the Oxford University Economics Department and the then Business College, Templeton College. And essentially what that collaboration was about developing a model of the global economy, which over the past 30 years or so has gone on to be the most widely used model of the global economy around the world. It's used by around 1,500 corporations, financial sector institutions, governments, and so on. And that model of the global economy has also gone on to generate a range of satellite models and forecasts as well. So things like our global industry service, which I'll be presenting some key insights from, as well as our global tourism and travel service, as well as our global investor strategy service as well. We're still headquartered in Oxford, but we're based in 20 offices around the world now. In Singapore, we have our headquarters for our consulting work in the APAC region, but that's working very closely with our colleagues in Tokyo, Hong Kong, and Sydney as well, where our macroeconomic and financial views for those regions are formulated. We work with clients across financial sector, corporate sector, and also government as well, but and also including obviously the industry sector, including a whole range of the different manufacturing sectors and supply chains. And we work with them in a variety of ways, either producing bespoke models and forecasts for them, or providing bespoke data feeds into the internal forecasting and strategy work that they do in-house. Okay, that's a whistle-stop introduction to Oxford Economics. In today's session, in the next 15 to 20 minutes or so, I'm going to cover, I guess, 5 or 6 key issues. Firstly, taking a look at where we stand in the global recovery from the COVID-19 recession, and then asking whether or not 2 of the big news stories from the past month or so change the outlook. So specifically, the outcome in the US presidential election. What does that mean for the global recovery and some of the risks that businesses have been worried about for the last year or 2? And then secondly, what the latest news feed on the vaccine means for the outlook across the world economy and different sectors as well. And then once we've settled those 2 questions, we'll look at how we're thinking about economic recovery prospects across Asia and also across sectors of the world economy. So specifically, in the manufacturing sectors that I know you'll all be very interested in. Okay, just to kind of recap where we are then. Obviously, you'll be aware that it's been a very unusual year for the world economy and for the world more generally. But the kind of severity of the chokehold on the world economy from COVID has clearly been loosening through the year. One way in which we've been tracking the extent to which businesses and economies are constrained is the extent to which households and businesses are being prevented from going about their normal business. And a nice, easy way to track that is the proportion of school students that are off school and therefore being kept home, and therefore their parents are unable to work. And as you can see, that's gone from around 1.5 billion students in the second quarter of this year to pretty much just a couple of 100 million. So that proportion, or that number, has fallen by around 90% through the course of the year, and that's facilitated a gradual return to work through the second half of 2020 in particular. So while we might not be able to do all the normal things that we'd like to be able to do, clearly businesses have been getting back to normal through the second half of this year. That's been accompanied by a broad-based rebound in a lot of the economic and financial data that we as economists follow. But for you guys working in industry, this is what you'll see in the bottom line, obviously. So we've seen, for example, world trade rebound through the second half of the year following a contraction that was pretty much in line with what we saw in the great financial crisis. So a very sharp fall in global trade volumes, but followed by an equally sharp rebound. And a similar story in labour markets and with regards to companies' investment intentions as well. Again, quite sharp rebounds on both of those metrics. But as we'll see later, we're moving to something like what The Economist magazine would call a 90-95% economy. So these rebounds are very sharp, but they're not taking us yet back to pre-COVID levels of output. And we'll discuss one or two reasons why later in the session. So that's where we stand. What about those two big news stories from the last couple of months? Well, after a few years where President Trump has obviously been throwing fireworks and hand grenades into the world trade policy system in particular, I think a lot of people were hoping that a Biden presidency and a Democrat government would result in something more of a renewed spirit of globalization. And that's true to an extent, but it's also important to be aware that we're not going to be going back to the freewheeling days of globalization and ever decreasing trade barriers, certainly as far as the US and China is concerned. So if you look at polling of the average voters' views about China in the US, you can see, for example, that the average Democrat voter is now as cautious about the US's relationship with China as the average Republican voter was 4 years ago when the US elected Donald Trump. And so we expect to see a more constructive and less isolationist relationship between the US and China. But it's nevertheless going to be one based on President Biden's interpretation of what matters from America's interests. So we would expect to see no new trade agreements negotiated between the US and other countries around the world, specifically China, until US manufacturing is back on its feet and the US is able to extract concrete commitments from countries that it might be trading with to invest in US manufacturing, for example. We would expect to see tariffs on steel and other sensitive sectors that the US has imposed on non-China economies. We would expect to see those roll back, but those will remain in place as far as China is concerned. And more generally, we would expect to see President Biden taking a more collaborative approach to tackling what the US sees as difficulties in its trade relationship with China. So we expect to see the US working with, for example, Japan, the EU, and other economies in order to take a unified approach to questions like intellectual property protection in China, the role of state-owned enterprises, and so on. So it's expected to be a presidency that has similar aims, but perhaps very different means and methods. So a more collaborative approach, but nevertheless one that is based around what works for the US in President Biden's view. So a more predictable form of protectionism, perhaps, and more focused on China, but nevertheless a continuation in some key respects of what we've seen from the US over the past few years. Now that's potentially not such great news for China, although China's growth model, as we're all aware, is rotating to one that's more domestically led. But it has been positive news for one or two other parts of the Asian manufacturing supply chain. So, for example, Taiwan and Vietnam have both made substantial gains in US import markets over the past few years, increasing their share of US imports by 1 to 2% over that period. And we would expect that to continue to be the case as US importers substitute away from China to either lower cost manufacturers in the case of Vietnam, but also just alternative suppliers of key sensitive tech sectors such as semiconductors, as in the case of Taiwan, for example. So that's our interpretation of the outcome of the US election for the global economy. The other big news story, of course, is the breakthrough in vaccine testing and the news that 3 candidate vaccines in particular seem to be very positive candidates and likely to help roll out a global vaccination campaign through the coming months. And we saw the first vaccinations taking place in the UK this morning. In our view, this is obviously very positive news, and the reaction in financial markets and the very limited economic survey data that we've had since then has been very positive. But it's more consistent with what economists have been building into their forecasts through the course of the past few months. So the direction of travel has very clearly been that with so much research, so much testing going on, there was an expectation that we would be at this point by now. And therefore, our interpretation of what's happened in terms of the outcomes, the testing, the rollout, is more that it corroborates our view of our baseline forecast. So our baseline forecast of a fairly rapid rebound in 2021. That's based on assumption that around by the end of 2021, we would expect to see the global vulnerable population having been vaccinated. And in turn, that will allow governments to really ease back on social restrictions through the first half of next year. And that will become permanent through the second half of next year. So through the second half of next year, we would expect to see, for example, most of the constraints around global travel starting to be lifted. And that's not necessarily to say that people will be traveling in the same numbers as they were a year or two ago, but nevertheless, that blockage to global commerce and global trade will have permanently and very substantially been reduced. And that's built into our global forecast. So as you can see from the chart here, we are expecting the pace of global growth to slow after rebounding very sharply through the second half of this year. And that really reflects the fact that in many sectors, the process of labour being shaken out, redundancies having been made, that process hasn't really run its course yet. So there are wage furlough schemes, for example, that are allowing sectors to keep people in work. Those are not going to be maintained forever, and at some point, businesses across a lot of different sectors, and we'll discuss which sectors in a little while, we would expect those to have to start making redundancies. That will slow consumer income growth, raise wariness amongst consumers, and there will also need to be a change in the tone of policy as well. So governments around the world have been injecting massive amounts of stimulus to support the rebound in 2020. They can't do that forever, and as governments start to try and balance the books, that will slow the pace of recovery. So on this chart, you really get a sense of what the permanent loss from the COVID pandemic might be. We estimate around 5% in terms of global output, a level shift compared to where we would have been had the pandemic not occurred, and that reflects, as I say, this loss in spending power amongst households and the fact that governments need to rebalance the books. We do have an alternative upside scenario in which we get a more rapid rebound. For example, a more rapid rollout of COVID vaccine in the early months of next year. Perhaps governments will support growth more than we would expect in the baseline, in which case we could get closer to the pre-COVID levels of output. But in our baseline forecast, as I say, we're expecting a permanent loss versus the pre-COVID path of probably about 5%. And the outlook varies quite a bit, depending on not just which region of the world you're in, but also where within that region. And the picture across Asia demonstrates that quite nicely. So this is a way of thinking about the prospects for recovery that's been developed by our chief Asia economist, Priyanka Kishore. And she was essentially looking at some of the structural factors that determine how quickly different countries across Asia can rebound. So how vulnerable is their economy structurally to the lasting impacts of COVID, the extent to which they rely on travel and tourism for growth and jobs, for example, the extent to which governments have actually successfully contained the pandemic, or they're having to take further containment measures, and also the extent to which governments have been able to support growth through 2020 and will be able to support growth into 2021, or whether they'll have to cut back. You put these various metrics together, you arrive at an overall kind of recovery score, and that correlates very closely with what we think the growth prospects for the last half of 2020 and into 2021 look like. So, for example, you have very positive recovery scores where governments have contained the virus early and are able to do most to support the recovery. So we're thinking about China and Northeast Asia in particular there. Whereas in contrast, in countries like the Philippines, Indonesia, and India in particular, where the pandemic is yet to really come under control, we expect the worst outlook across Asia for the next year or so. I mean, that's really reflected in our GDP forecasts. So the most positive outcomes for the last half of this year and into next year are to be found in Northeast Asia, and the most challenging conditions for the rest of the year in some of those more vulnerable economies, say India and Philippines in particular. And if you look at China, for example, the economy has essentially rebounded already above pre-COVID levels of output. So just as China was the first to go into lockdown in the first quarter of 2021, it was also the first to come out. And some of China's factories were very active in Q2 and Q3 in filling order books, where European factories, US factories, and factories around the rest of Asia were having to shut because of government lockdowns. So China essentially has been quite successful in taking a degree of market share of some other economies. That's about 2 to 3% of global imports over the past 6 months or so. And whereas obviously some of that is coming back off as factories around the rest of the world have come back online, we would expect, nevertheless, some of those new trading relationships to stick, even in light of the new trade barriers that have been put up between China and the US. Elsewhere in Asia, we're expecting Japan's rebound to be quite robust in 2021, and that's in large part because the government in Japan has been amongst the most aggressive in supporting growth through 2020. So the total fiscal package in Japan for this year has amounted to around 12% of GDP. That's unprecedented both in a historical and in a regional context. So we're expecting the growth outlook for next year to be very balanced between private consumption and business investment, but nevertheless pretty robust growth of around 3% in both 2021 and 2022. And then just finally on some of the key economies around Asia, we're starting to see a real rebound in consumer spending and consumer optimism in India. So kind of highlighted by recent trends in auto sales, for example, which are up anywhere between 20 and 40% year on year. Very positive rebound in terms of consumer spending power. But our view on the longer term in India is a bit more cautious, to be honest with you. This chart shows our breakdown of potential growth. So this is the kind of speed limit for the economy in India. And in our view, that rate of potential growth over the coming 5 years is around 2 percentage points lower than prior to the pandemic. And this is essentially as a result of lost business investment in particular. So a real blow to business investment that will undermine the rates of long-term growth for the coming few years in India. Just putting that in context, here you can see our view of the loss in GDP versus the pre-COVID counterfactual. So the red dots are the difference in 2020, and then the blue bars are the difference by 2025. And the greater the distance between those two bars, essentially the greater these economies have the potential to catch up for lost growth over the coming few years. And as you can see, the loss is going to be most durable in some of those Asian economies which are yet to contain the COVID pandemic. So India, Philippines, and Indonesia in particular, we think will see the greatest lasting impacts from this pandemic. Just say a couple of words about some of the other major parts of the world economy, and then wrap up with some industry insights. As you'll probably be aware, much of Europe is back in lockdown for the last quarter of this year. We think that that's pushing the Eurozone back into recession, but it'll be a much milder recession this time around than in the first and second quarters of this year. And that really reflects the fact that governments have in large part learned to manage the outbreak of the pandemic in a way that enables businesses to function more normally. So allows factories and offices to adapt and to continue working. So while the Eurozone is back in recession in the last quarter of this year, we're anticipating again a pretty rapid rebound in 2021, and again based on the assumption that the vaccine rollout program allows governments to start to ease up those social distancing and lockdown measures. A similar story in the US, where we had a very rapid rebound through the second and third quarters of the year, but more recent data is starting to show the recovery tailing off. Again, that's partly due to increased stringency measures, lockdown measures, as the US has entered essentially what looks like a third wave of COVID. But again, based on the assumption that the US is able to roll out the vaccine through the first half of next year, we would expect again to see a continued rebound in the US economy. Now, what's interesting about the US economy is that there's quite a range of growth paths that we were looking at prior to the US election. This range is shown here in this chart, where essentially we have an upper bound and a lower bound. The lower bound is what we think would have happened had President Trump won the election. So it would have been essentially tax cuts skewed to the rich, further constraints on trade and migration in particular. And then the upper bound is what we anticipate would have happened had Joe Biden won both the presidency and control of the Senate. And in which case he would have been able to implement very liberal migration policies and potentially a more stimulative fiscal bill as well. Well, actually, with the president, or with Joe Biden in the presidency, but the Republicans in charge of the House, we think that President Biden will be a bit more constrained in how much he's able to support growth. And so we think the long-term loss in the US is going to be around 3 to 4% of GDP, a much greater loss than we think would have been the case had President Biden been able to implement his full policy agenda. Just to wrap up on the global outlook, as you can see, as we were saying, China already well above its pre-COVID level of output, and the rest of the world taking anywhere between 1 and 2 more years to get to that point. Europe being the last in the race to get back above pre-COVID levels of GDP. And then finally, I'll say a couple of words about our industry forecast. My colleagues in our global industry team have been looking at the sectors of the manufacturing supply chain that are most exposed to high contact service sectors. So high contact service sectors, we mean specifically those like either physical retail or travel and tourism, hospitality, restaurants and accommodation services. And essentially you can see that the 2 most exposed sectors in those respects are, for example, the food and beverage and also aerospace and other transport manufacturing sectors. So those have the most to lose from what we've seen through the COVID pandemic, but their outlooks are a little different because, of course, one of those sectors, aerospace and transport equipment, is very large ticket, relies on business confidence, and that will take some time to rebound. But some of those other industrial sectors, so food, pharma, chemicals, for example, we see the outlook for those being very robust over the next year or 2 as governments continue to take the measures necessary to contain the pandemic. Okay, that's all the kind of the comments I have. I'll leave us back on our opening page where we had the key issues. And Roxanna, I'll hand back to you, and I'm either happy to take questions now or at the end of the session.
Thank you so much, Tom. Thank you for sharing your expertise with us. And yes, we're gonna take time for questions. Just a quick reminder to everyone, please be sure you type your questions at the control panel. And we do have some questions in. So the first is related to the Regional Comprehensive Economic Partnership. So how do you think this partnership is affecting the trade of products as natural rubber and synthetic rubber, which are commodities in this region?
Yeah. I mean, I would imagine the RCEP will affect more the trade in the final manufactured products. So the reduction in barriers around manufactured goods, autos, and those sectors in particular. I mean, I think more generally, what we're starting to think about in terms of the global trading policy framework is that we're starting to see more regionalized trade policy agreements like RCEP, ASEAN deepening, for example. And in that context, I think probably the risk is that we start to see potentially decoupling of blocks of the world economy. So, for example, one of the things that Donald Trump has tried to do is detach China's technology and industrial cycle from the US. And while measures like the RCEP are obviously very welcome and they can stimulate trade and investment flows around Asia, the broader risk is that that takes place at the expense or at the exclusion of attempts to try and properly integrate or to reduce the barriers to global trade. Reducing the barriers to trade between the world's largest economies, we think will be very important as well. And although RCEP and other initiatives are obviously very welcome in an Asian context, we would like to see more global liberalization as well.
Thank you. Well, talking about globalization, do you think are the economic and political factors slowing globalization going to persist on this decade? And what will be the COVID-19 crisis implications for globalization?
Yeah, I think, politically, COVID has clearly been a very damaging blow to relations between a lot of different parts of the world economy. We were seeing just yesterday, quite high-level disputes between China and Australia about responsibility for COVID, and fairly petty and difficult political exchanges between major governments, and that's obviously a barrier to the goodwill that is necessary to taking difficult political decisions that are part and parcel of trade and investment agreements. So clearly COVID will be a barrier, or will be a challenge that needs to be overcome in the context of re-globalization. But as I say, the key measures that are being taken, or the key initiatives that are now being pursued in global trade and investment policy are now regional. So they're regional within Asia, regional within Europe, for example. And we would expect President Biden, for example, to prioritize rebuilding his relations with his North American trading partners, primarily and initially ahead of lowering trade barriers with China. So I think COVID hasn't necessarily accelerated that process, but it's certainly not made it any easier. It's certainly not made the spirit of global cooperation easier to come by. So it's certainly a challenge that the world will need to face over the coming. But having said that, having a more multilateral and more constructive president in the White House is a big step in that direction, we think.
Great, thank you. Seems like we have covered all the questions. We will continue with the next presentation. Thank you, Tom.
Thank you.
Hello, everyone. It's my pleasure to introduce our next speaker, Juan Ramon Salinas. Mr. Salinas has more than 30 years of experience in logistics, customer service, quality system, project, process management experiences. As a business leader, he is able to lead multinational team, identify and develop and pursue business growth strategies. Also, he has international business knowledge and market intelligence. Mr. Salinas is the current Executive Director and CEO of IISRP, the position he has held since 2015. Before this position at IISRP, he worked more than 17 years at Dinosaur, holding various roles such as Commercial and Global Marketing Director, Marketing and Business Development Manager, Logistics and Customer Service Manager, Technical Customer Service Manager. His previous work experience is in the plastic industry. Mr. Salinas has BS in Chemical Engineering and Business Administration from IPADE, Mexico. Welcome, Juan Ramon, to our webinar session. We are excited in having you today. And from this point onwards, you will have the control of the presentation. Thank you.
Thank you. Just let me start.
We can see the okay, there.
Yeah, yes, I think it's a little slow. And yeah, I think everybody is seeing the presentation.
Yes.
And hello, everybody, and thank you, Lekshmi, for your kind introduction. Let's start with the agenda of that going to include in my presentation. The first point is related with the global capacity and main players. After that, I'm going to include comments regarding the new projects and expansions. After that, I'm going to cover the supply and demand. And at the end, I'm going to talk a little regarding the challenges of the synthetic rubber industry and some opportunities. And the first, the first topic is the global capacity and main players. First, we look at the global production capacity by region. And we note that the total world nominal capacity is 20,392 KT. And about 55% of this capacity is located in the Asia Pacific region, including China. China is around 26%, and the rest of Asia Pacific region is around 29%. Europe, Africa, and Middle East, and also North America have around 16. And during the last year, we have some plants closures and also we have a new capacity, and the balance, the growth balance is around 130 KTs, most of them located in the Asia Pacific. And if we review the trends, we can see that the Asia Pacific region overtook the China capacity and the end of the 2016, since most of the projects and expansions are taking place in that region. Moreover, additional capacity was planned in Asia Pacific and EMEA's region to come on stream between 2020 and 2023, but these projects maybe could be delayed due to the actual situation. If we review the synthetic rubber capacity by elastomer type, we can see that the tire elastomers like emulsion SBR, solution SBR, and BR making up almost 60% of the global capacity. However, the tire elastomers are the ones that have contributed to the most of the overcapacity situation that we are facing since quite some time. If we review the trends of the capacity VR and solution SBR, it is observed that they have been expanding faster than other elastomers due to the demand for high performance tires. However, lately, this trend is slowed down in these two rubbers. On the other hand, we have seen gradual expansion changes in EPDM and butyl rubber. Additionally, Styrene butadiene copolymers have seen a steady growth in capacity, with more capacity planned to be operational in the next 2-3 years. But of course, with the pandemic crisis, it's possible that many of these projects will be delayed at least some time. Now let's see how the producers compare in size. 24 companies compose the 80% of the total production capacity, according with our 2019 numbers and analysis. On orange is the actual active capacity, and on gray is marked the idle capacity of these producers. And if we pass for the next topic, we're going to cover the new project and expansions announced for different elastomer types, which were planned to be on stream between 2021-2023. But we are expecting delays due to the actual economic crisis. Starting with BR, considerable investment has been made for BR capacity since 2011 due to the demand for high performance tires and green tires. You will also note that some BR capacity went idle in 2016, 2018, 2020 due to the overinvestment made in current situation. But additional 22 KT are forecasted in Asia Pacific to come on stream in the short term. In contrast, emulsion SBR case, we have not seen any expansion lately, as this elastomer demand has declined since 2012. Some capacity was idle in 2014. There have been several closures in recent years. One of them in Americas, the second in South Africa, and also in China. No. In addition, around 200 KT was inactive last year. Solution SBR capacity has expanded rapidly and perhaps too fast. And a lot of this has to do with the demand for high performance tire. Lately, this expansion has slowed down. The additional capacity became operational between 2018-2019 in the Asia Pacific region. Now there is no additional capacity plan in the short term. And BR, we have seen a modest investment made in MBR capacity and in North America facility closed during 2017, but no further investment is expected in short term. Furthermore, the demand of MBR has improved in recent years. SBS or SBCs. There has been constant investment in SBCs capacity in recent years. An additional capacity has been announced in Asia Pacific, Europe, and North America regions between 2021 and 2023. But due to the current economic crisis, we believe some of these projects could be delayed. EPDM. We have seen an expansion in EPDM capacity in the last 6 years, with the majority taking place in Asia Pacific. This region was a net imported. So with the new capacity, the trading picture is changing. Besides, a large investment was made during the 2017 that added around 300 KT in North America and Asia Pacific. On the other hand, Arlancio recently announced the closure of its facility in Orange, Texas. This closure and the closure of the SK plan had been included in figure 2020. Polyisoprene capacity addition occurred between 2014 and 2016. However, around 120 KT went dormant in China in subsequent years. No further expansion were expected shortly. For butyl rubber, significant investments were made between 2017 and 2018 in the Asia Pacific region. However, around 100 KT were idle in China in 2018. No short-term additions are expected for now. Now, having reviewed the global capacity data, next I will cover our estimate in supply and demand. The following information is based on the quarterly program that we carry out with our members. First, I'm going to cover the BR, butadiene rubber. BR supplies and demand has been improving in recent years, supported by the demand in the EMEA and Asia Pacific region. However, demand is decreasing in 2020 by at least 14%. Of course, the actual situation. This due to the impact of the pandemic crisis around the world. Here is also the estimate in China too. The demand increased in last quarter, but still the market was affected in 2020. The operating rates have decreased, but have been signs of improvements for the second half of this year. Supply and demand for emulsion SBR has been declined since 2014, and the total operating rate is a big concern. So this downward trend worsened in 2020 due to the COVID outbreak. So one point to note is the supply and demand for this rubber in China was improved in 2019 during the fourth quarter, but COVID-19 arrived and reached its lowest point in early 2020. But we await an improvement in demand following the recovery of the tire and auto industry. The demand for solution SBR has grown in recent years, and this trend was constant in all geographic regions. But in 2020, it has been a decrease in solution SBR consumption of at least 15%, caused by the global economic impact of the COVID pandemic. This impact was observed in all regions, geographical regions. This also was also seen in China in early 2020 after a peak in demand in late 2019. Signs of improvement are already seen in the second half of this year. MBR, our estimate shows that the supply and demand for MBR have improved in recent years. China also saw an increase in demand in late 2019. But the COVID outbreak has brought a large decline in demand driven by the auto industry contraction. On the contrary, the medical glove segment became a growth opportunity, which is expected to double its capacity by the end of 2020. SBS. Supply and demand estimates have shown a steady growth for SBS products. In China, there was a growth in demand in the last quarter of 2019. But in the same way, the economic crisis triggered by the pandemic has had a significant impact of the market for SBS in all geographical regions. But this drop was not as deep as the observed in the tire elastomers, since the SBS is used widely in asphalt modification applications. And the infrastructure sector has been considered as essential activity. Thus, improvements were observed during the paving season. The global supply and demand for EPDM expanded in recent years. And there was a significant increase in China at the end of 2019. But the COVID outbreak has brought a large decrease in demand driven by the contraction of the auto industry, where EPDM is widely used. But improvements have been seen in the second half of 2020 as the auto industry recovers. Next, I'm going to cover the challenges. The ongoing impact of the COVID is still widely visible and is significantly affecting several industries, and the synthetic rubber industry is not an exception. Supply chains have been disrupted, unemployment rates had skyrocketed, and the public health crisis has intensified in many countries, even now. Despite implementing unprecedented government and stimulus packages, let's take a look at the challenges ahead in the short terms. Over the time, we have discussed how different challenges have and continue to impact the synthetic rubber industry. But today, I will focus on the immediate concerns, which is the uncertainty. International trade was already showing signs to slow down in 2019 due to the trade tensions and weakening economic growth. Then the economic shock caused by COVID-19, the moment restriction and social distancing have affected entire economic sectors. The World Trade Organization now predicts 9.2% drop in the world trade volume for 2020, following by 7.2% increase in 2021, which is on the side of the weak recovery. These estimates are subject to a degree of uncertainty, since they depend on the evolution of the pandemic and, of course, of the vaccine results. Today, there are already several vaccine options, but if this situation continues, uncertainty will continue too. And the trade will likely fall even more in sectors with complex supply chains like the auto industry. The economic growth situation, Tom has spoken in detail about the impact of COVID-19 in the world economy. Just I need to make some remarks. In this case, the global economy is expected to continue to recover from the coronavirus pandemic, but it could last for years. And analysts estimate productions in part of Asia Pacific and the United States to get pre-pandemic levels. China has already made up for loss of production. Some risks include economic malaise catalyzed but ineffective virus contained, and governments and central banks not necessarily do not provide enough support. Regarding the end-use application, the auto industry is the primary driver of synthetic rubber consumption, and this includes also the tire industry. So let's look at how the outbreak has affected the auto industry and the tire sector, which are the largest consumers of the synthetic rubber. The auto industry and players within the mobility industry are among the hardest hit. First, global light vehicle sales are forecast to decline in the range of 15 million units during the last year. All geographical areas will see the same situation, but a moderate recovery is expected in 2021. On the other hand, China showed promising results during the summer, but is estimated to decrease in the coming months. But now the Chinese market continues to shine in the worldwide. For the tire industry perspective, the picture is not different. Global demand for passenger vehicles and light truck tires collapsed as lockdown policies gradually spread around the world, of course, negatively affecting all markets. That would result in a total reduction in demand around 15% this year. The data of this screen comes from Michelin third quarter report. You can see that the replacement tire segment was down approximately 15% globally. However, positive signs starting being seen. Before the pandemic outbreak, the auto industry was undergoing a significant transformation process. And we speak that is heading towards electrified auto or electric autos, self-driving or autonomous autos, shares, and connected mobility. That are the macro trends in the auto industry. These trends continues, but maybe have some adjustments as the pandemic could have as impact on mobility. It continues to drive microeconomic change, environmental, regulatory trends, technology, and consumer behaviors. Of course, the synthetic rubber industry should adapt the products and process regarding these trends. In mobility, according with McKinsey and Company report, COVID could impact mobility in short term. The table shows some changes that are expected. For the point of view of the consumer behavior, most regions will move away from shared mobility and public transportation, or at least make adjustments and changes, because sometimes it's not possible to avoid the public transportation, but we need to make adjustments. For the perspective of regulatory developments, emissions regulations will become stricter in some regions, and maybe we can see more incentives to buy electric vehicles. For a technology point of view, autonomous cars technology could have some adjustments in the timeline, and is forecast that the startups to come under pressure due to the capital shortage. And let me close my presentation with some comments on the opportunity that we see. Just as we face many challenges, we may also have some opportunities ahead this time. Even so, the coronavirus outbreak is in key electric vehicles brands led to a significant slowdown in sales, but this will be only temporary. In the short term, emission regulation are expected to become stricter. And governments we expect to give additional incentives to buy electric vehicles in some regions. And of course, this kind of vehicles requires different kind of rubbers. This trend also requires high performance tires. In addition, COVID-19 is expected to have a short-term impact in the medical supply market. It's expected to achieve around 13% growth during this year. And synthetic rubber is also used to make medical protected equipment supplies for infusion and injectables and medical equipment. And of course, it's an opportunity there. And I think it's everything I prepare, and I will be happy to answer your question. And thank you.
Thank you, Juan Ramos, for sharing your expertise with us. Some question I can already seen in the chat area. You have already mentioned about the likely slowdown and the negative impact which can coming in the raw material requirement because of the mobility slowdown and the transport sector slowdown. One question is addressing the BR capacity. You have mentioned that there is an increase in the BR capacity in 2021 onwards. When the demand is not likely to increase significantly, what is your comment on that?
Yes, there is one small capacity that is announced, but of course, also in the past years, they were several plants closed out. And of course, this trend could be happening in the coming years too, because adjustment in the supply demands could happen. My second comments could related with the flexibility and with several that can have several producers. Several technology and several plants have the flexibility to switch the rubbers production types, elastomer types, and they can switch for one elastomer to another elastomer. Of course, if they have this kind of flexibility, they can use the capacity with another elastomers. Of course, in the short terms, maybe 1 or 2 years, the recovery is going to be gradually increased. But maybe we're going to see several plants close out or something like that, and this adjustment going to happen. And also the flexibility maybe is another trend that they going to have the opportunity to use the capacity in another kind of rubbers.
Thank you. The another question which is also coming from the participant, it is more or less you have covered that question during your discussion, because the downstream industries we are facing a slowdown, or it's of course it's a negative growth for this year, and how the raw material side, especially the synthetic rubber makers, are seeing the downstream customers slow down since March 2020.
At the beginning of this year, so everybody know with the lockdown and the supply chain disruptions, the synthetic rubber also industry also slowed down and closed out, and the consumption and production was reduced sharply. In the second half, and of course, several elastomer types were affected in different levels. The tire industry rubbers, in this case, emulsion SBR, VR, and solution SBR were impacted, and EPDM include in more percentage comparing with, for example, SBS or another ones, and VR and another kind of rubbers. Because certain kind of applications could be related with activities that were essential during certain time. In the second half, during the summer and second half of this year, the activity increased movements or rates. And of course, also we saw during the second half the recovery in the rubber productions. And we're expecting that the next year that the recovery is going to be higher and comparing with the second half. But of course, going to take maybe 2 or 3 years to have the levels that previous to the COVID situation. And but depends of the elastomer type, could be less. For example, in the SBS, maybe it could be less, but we need maybe 2 or 3 years in order to see the previous rates before COVID.
Okay, thank you very much. Of course, there is spare capacity, and then many of the end users lower requirement is needed, and then of course,
yes.
What is the efficient operating rate? That
yes, because the synthetic rubber is in the middle of the supply chains, and we depends of our end use application to make a recovery there. And of course, we're going to follow that trend too.
Okay, thank you very much. I think it's we don't have much time to take more questions, and we are moving to the panel discussion, and I'm giving the floor to Roxanna.
Thank you. Salvatore?
All right, everyone. Now we have this panel discussion, and we have all the panelists. Juan, Ramon, and Tom is around, right? And Lekshmi and Roxanna are here to answer your questions and some other questions that we already prepared that should be on the screen, right?
Yes, that is correct. I'm gonna go ahead and go over the first question that we have. The pandemic could leave lasting impacts on the level of GDP. So the post-pandemic growth provides an opportunity for green recovery. So is additional investment for green recovery going to be economic booster? And in this case, what will be the position of China? Tom?
I think it's Tom, right?
Shall I have a first go at that?
Yes, please.
Yes, please.
Okay. Yeah, I mean, I mean, as I said, you know, at the global level, we think that the loss in GDP as a result of the pandemic is about 5%. In China, it's 0. So China's back on what we would regard as a pre-COVID growth path, and that's in large part because what China lost in Q1, it made up in regaining market share in Q2 and Q3. That's that's less the case for other parts of the world. And obviously the damage done by the pandemic, the number of cases, the length of lockdown measures was much greater in other parts of the world economy, and that's why the loss in GDP is going to be much greater. In terms of green recovery, I mentioned that the governments around the world have been pushing out unprecedented levels of stimulus. Not very much of that has been targeted at supporting green recovery. So the priority most urgently has always been to put households in the position where they could self-isolate without fear of losing either their jobs or their income, and that those types of wage subsidy schemes are not particularly targeted in a green fashion. Likewise, in terms of the finance that's being offered to firms across sectors, soft loans, credits, tax breaks. Again, that's not targeted in a green sense. So stimulus measures and the support measures that have been put in so far haven't been particularly green. And loath as Oxford Economics would be to flag the work of one of our rival economic consultancies, I did see a very interesting study that was produced by Vivid Economics and the Foundation for Biodiversity, and they looked at the proportion of stimulus packages, or the number of stimulus packages implemented by governments around the world that have had an explicitly green focus, and it is very few. I think there are one or two countries within Europe, for example, where the explicitly green recovery portion formed a significant chunk of the overall stimulus package. But that's what's happened so far, and the focus for governments around the world will be putting their books back in order now. So scaling back those very generous support to households and businesses, and perhaps where there is weakness, where some sectors are having to shut down, for example, where travel and transport is facing up to slower growth in the future, governments will be looking to support those sectors if they feel it's needed, in a way that incentivizes behavioral change or adaptation of new technology, for example. So I think the green aspect of recovery is more likely to be seen in the medium term, or from 2021 onwards, than it has been thus far, because the focus the governments have had in the short term has been very much in terms of preventing households and businesses from going bankrupt and allowing a COVID crisis to turn into a financial crisis. And China's obviously, as I say, it's lost the least as a result of COVID in terms of long-run growth. But China has also been one of the economies that for the longest time, or for the past few years, has been doing the most to try and accelerate the shift towards greener growth. And again, we would expect that to continue. So accelerating the energy transition to solar, for example, is something that China's been doing for a long time. We would expect that to continue to be the case.
Thank you, Tom.
Thank you, Tom. And especially with the specific to China, the point you raised, we have seen a lower consumption for many of the raw material, but at the same time, China has made the commitment of net zero by 2060. So many of the large investment, it's especially on green energy side, certainly will come in the medium term. That could accelerate many development on China-centric. So that is a direct as well as an indirect impact of the green transition.
Thank you. Anyone additional additions to this topic?
I think there was a question from someone that I wanted to put to Tom, because it was about, now we have seen you show the graph of the economic recovery next year, but Don't you see any danger of a second economic crisis due to bankruptcy waves, especially in some regions like Europe, maybe, where in some countries you have small, medium companies that have been kept afloat by government's incentives so far, but when this will be end, they might find themselves in trouble?
Yeah, I think that varies quite a lot by sector, and you know, in the accommodation and restaurant sector, for example, we know that there will be a wave of consolidation. You know, to put it politely, but bankruptcy is probably more accurate. You know, in the UK, for example, we had an Eat Out to Help Out scheme, which subsidised meals out, and that drove a lot of traffic in that sector in the summer of this year. But I mean, the government can't afford to continue that indefinitely. So we know that sectors like that, where the restrictions that are now in place, still in place, will likely be in place for a few months yet, while the vaccine is being rolled out. We expect there to be you know, a process like you described. But in a lot of the manufacturing sectors, you know, growth has rebounded very rapidly, and you know, with interest rates expected to stay very low for several years yet, you know, the ECB, the Federal Reserve, Bank of Japan, not going to be raising interest rates for many, many years, we don't think, and that will ease pressure on central banks elsewhere around the world to do so as well. So we wouldn't be expecting interest rates in emerging Asian economies to raise within the next 2 to 3 years either. So companies will have a time to get used to the new normal with relatively cheap financing. And you know, one of the things that we didn't see in the great financial crisis, for example, is a wave of corporate bankruptcies. It was a financial crisis rather than a corporate financing crisis. And that was because interest rates were kept, you know, incredibly low for quite some time. And I think the same will by and large be the case in 2021.
Thank you, Tom. Thanks.
Thank you. So let's go to the next topic. So this is really more related to the synthetic rubber industry. What do you think are the main challenges that the synthetic rubber industry will face post-pandemic?
Okay, I think I need to answer this one because it's not related with the synthetic rubber industry, or is related. I think going to be the same that we had previously, because just with the addition with the economic crisis, but because as I mentioned before, the auto industry is in the transformation process. They have several macro trends like the autonomous cars, the connectivity, to share mobility, all these kind of micro trends that were mentioned. But of course, the COVID now has an impact in that in those industry, even in our industry. But those trends going to be working in the after pandemic normal. They're going to continue to work in that trends, maybe faster than before, according with depends of the effects of several things. And of course, the industry, our industry, synthetic rubber industry, has to transform to make a transformation too, following those trends, and that those means that we have to work with them in order to follow in that trends. For example, if we're going to work in airless or tires without air, it's necessary maybe to produce new rubbers. Or the tires, the auto-healing tires, or maybe need also new rubbers. The electric vehicles also are going to make a rearrangement of the necessity of rubbers, because the number of parts that the electric vehicles needs is different comparing with the combustion vehicles, and going to make a rearrangement of the consumptions. And that also create necessity to transform also the synthetic rubber industry in order to commitment or to meet that requirements. And of course, the other part of the trends is the environmental requirements. And one of these challenges is to transform the synthetic rubber industry in, or to take a synthetic rubber industry circularity business model. And that give us additional challenges because also it's necessary to work in our process and our logistics, and transform and became business circularity companies. And of course, include the phase or the parts and the raw materials, because now the raw materials, most of them are became from the oil industry, but the circularity also include to work in that section or area and work with the biomass monomers in order to have more sustainability and more environmental friendly concepts. And logistics also is the same, application is the same, that we need to have new rovers, and the technology going to be a critical part in that transformation, because we need to meet requirements, environmental requirements, technology requirements from our applications, and of course the inside requirements, and these include the process requirements with circularity point of view, and of course investment needs in technology and maybe new process.
Any other additional comments?
Ramon, do you envisage for synthetic rubber industry a different business model? Because in the future, in the sense that we have seen, for instance, the tire makers are also changing. They are less tire makers and more service providers, and I think this move will be more and more evident also in the next future. So is the synthetic rubber industry envisage any change in the business model because of this or not?
No, not at this moment, but we need to follow with that trends because if we have to keep this industry in the market or in the business, we need to transform also the model business, including the marketing point of view, like the service as a product. And because our customers, the auto industry, the tire industry, the plastic industry, the construction industry also are moving in that direction. If we are not moving in that direction, they're going to find out another way to meet their own strategy and our trends. And that is the point. We need to follow the trends, but in the worldwide, really, the new business models are going in the circularity model and the service marketing as a service product, and we need to do that. And I don't know how long going to take this transformation, because We are talking about maybe 20 years transformation, 10 years transformation, maybe more, maybe less, depends. But we are seeing that. And in our association, we are also pursuing the circularity business model in order to start with a certain strategy there.
Thank you.
Great.
I think we can move to the next one.
Yeah, let's move to the next one. Hold on. Yeah. We have a lot of inquiries about the NBR latex and the demand for glove sector. And you want to address this. And after I have a question that it was raised during the presentations about this, so I will add that. Go ahead, please.
Okay, the pandemic has fueled the robust growth in the gloves used in the medical segment. So even before the pandemic, the industry has seen 10 to 12% growth in the gloves market. So especially that we have started seeing in the NBR latex market. Main reason for that is the first of all, it is the allergy for natural rubber latex. That's the type 1 allergy, especially that is reported in the Western market. And along with that, we have seen an organic expansion of the gloves manufacturers on their NBR latex lines. So these two together has fueled a growth of 10 to 12% in the pre-crisis period. But during the pandemic, actually the industry has seen around 20 to 25% growth. So the major players in the gloves market are 3 countries, Malaysia, Thailand, and China. So 67% of the market share of the gloves is with Malaysia, and 10%, 18% with Thailand, and 10% with China. So around 2 million nitrile latex demand, and out of that, 96% goes to the glove segment. So China already announced additional 1 million capacity for next year. And looking at the cost composition of the NBR latex gloves, around 40% of the cost goes to the NBR latex cost. And certainly that gives China an upper edge for further expansion of the NBR latex gloves, which of course it is going to be export driven. Even though the vaccine is already there and going to be rolled out soon, but for 2021, certainly yes, the gloves requirement and gloves demand in the healthcare sector will continue.
Thank you. Well, there was a question during the presentations. Why has NBR demand dropped in 2020 if the demand of medical gloves was strong during this year? So I have a comment on this. NBR is also used for automotive applications. So that's the part that has dropped, and basically NBR, and as Lekshmi already addressed, NBR latex in latex form is the one basically used for glove sector. So we talk about the NBR latex in the solid form, talking about different demand, and more of that demand goes to the automotive industry. Yes. In addition to this topic.
Okay.
We have seen a very quick comment. We have seen some of our rubber producers doing some capacity adjustments. They usually have a motion SVR production, which is being transformed to the NBR latex assets to address the demand for the glove sector. We have seen that, and a couple of those producers, one in Russia and another in Asia Pacific also, they have announced investment on expanding their facilities, but exclusively for the NBR latex production, and of course driven by the demand of glove sector.
Okay.
Nothing else here, so the next topic on this panel: how much rationalization of the synthetic rubber capacity is expected in the short term?
As we mentioned, and really they're going to depend on how the recovery going to happen. But of course, we are expecting a little rationalization, but maybe the flexibility in the plants can help the producers in order to keep the production, in order to use this capacity and other kind of rubbers momentarily. But it's possible to see it. And of course, if we see also the tire industry investment for the future capacity, the tire industry is not necessarily have an investment to increase the capacity of production. And of course, we can see maybe a little more rationalization, mainly in the tire elastomers.
Well, Ramon, in which region do you see this rationalization happening? I mean, is China involved in this or?
Really everywhere. Depends of the kind of rubbers and the type of rubbers and where the capacity. Lately was seen in certain areas or certain kind of rubbers in China, but really it's everywhere. Depend of the rubbers. And depend of the competitive of the companies, because in this case is depend of the competitive and the situation.
Usually in China, what they do, they idle capacities and they bounce back depending on the demand. They're more flexible in that direction. In another regions, because they can afford to do that, in other regions where the manufacturing is having higher costs, they really, if there are global companies, they basically doing different, changing the production on a different part of the world where is more competitive to have that production there. That's what we say usually.
And also it is, we already seen because of the lower demand, is a spare capacity, and there are some announcements which is to be in place for 2021. So then of course it is according to the requirement of the region and according to the requirement of the end user, it is the operating rate is going to change, and what is the efficient operating rate depends on the requirement and the region.
That's correct.
Maybe next one.
Yeah, we'll go to the next one. So for industry leadership priorities and opportunities addressing future product developments in the near and medium term, what would you like to?
I think it's related also with the needs that the application are looking for. And for example, I think most of the rubbers in the tire industry are going to be related with the new tires options that are developing, like the airless tire or the self-healing tires, so this kind of new tires, or the connecting, because the new trends is to have a lot of detection of the information in the tires or in the auto. This connectivity possibly needs this kind of rubbers, but a new kind of rubbers in order to meet this kind of requirements, because going to be different requirements. And also maybe in the long term could be auto healing rubbers, and also bio rubbers, because it's possible to have also bio rubbers in terms that could be bio rubbers using another kind of raw materials. But and of course now I think are more focusing in the new requirements in the auto and tire industry, and of course in another industries like the medical industry can be also needed some kind of new rubbers too. But everything is related with the application of the new application in the markets, and going to be the arrangement of the needs because as mentioned before, the electrical auto needs different level of kind of rubbers.
Yes.
Okay. Just to add,
Go ahead, please, Lekshmi.
yeah, add to that on the requirement of electrical and mobility, which many of the leadership already started committing on 100% circularity, 100% emission reduction, and net zero carbon. Of course, that line of sustainability commitment and the role that customers are taking, or the industry leadership need to address the climate protection policies, to what extent they can reduce the emission, whether it is scope 1, scope 2, or scope 3, and also to meet the customer requirement for a sustainable material, technology, and sustainable solution. These sustainability goals need to be addressed both in the medium and the long term. As Mr. Juan mentioned, it is certainly sustainable product design is part of that, and technology innovation is the leadership need to address that, and how the technology innovation can be brought within collaboration with universities and other research and development organization. I like to re-emphasize here, it is the collaboration is heart of the success for all these sustainability ambitions and the sustainable product design and development ambition for the industry leadership.
Right. I would like to add that also I'm convinced that very important the producers should adopt modern administration systems and the transformation of their capabilities to be able to respond the market requirements, because all these sustainable trends and solutions needed, they're already impacting the actual assets, organizations, and people. So very important to work on the administration of government systems within the companies.
Mm-hmm.
Ramon, one question. There is any emerging markets for synthetic rubber apart the changes that we are seeing in tire and in the automotive sector generally, but there is anything else that the industry is actually looking with interest at?
No big markets, just specialty applications, but there are very specific niche in the compounding industry, very specific application, aerospace, these kind of things, but are not a big application because they are focusing in specialty rubbers like a niche.
Right.
I think it's more related with the new trends and the applications.
Okay. So I think now we are getting close to the end of this event. Is it, Roxanna? Am I right?
Yes, that is right.
Yeah,
Yes.
And I would like to ask to the panelists, especially Tom and Ramon, maybe know what you would like this audience will take away from this session. So what is the main point that they have to get from our discussion today? Tom?
Okay, sorry. Well, I mean, I guess it's easy to be carried away by all the positive news that we've had over the last month or two, I guess, in particular. You know, you read the media, you look at financial markets, you see a lot of very positive news. But I guess what we're talking to our clients a lot about, particularly our financial sector clients who have lending across different corporate sectors, is helping them to understand the different outlooks across different industry sectors, and you know, the fact that consumer behavior is going to be different for a while yet. Consumers are going to be cautious about buying big ticket items. They're going to be cautious about traveling, for example. And so while there's a real wave of optimism that, you know, we are going to see a very strong economic rebound next year, the outlook is going to look very different across different industry sectors. And that's one thing that we're working with our clients to try and help them understand and to plan for in particular.
Okay. Yes, I think the first is that the synthetic rubber industry, as other industry, have a impact from the actual situation, the pandemic situation, economic situation, and of course have an effect or impact in the consumption. But the good news is, in certain way, the recovery is starting. Going to be necessary to pass several years in order to, maybe 2-3 years, in order to keep or to have or to get the pre-COVID consumption levels. And also that the challenges in the synthetic rubber industry is to become or to have a new business model taking in account circularity, business model, and sustainability.
Yeah. Lekshmi, you want to add anything?
Of course, adding to that, the different dimensions of the sustainability, which is more of the long-term commitments, the product development focusing on sustainability, circularity, and renewable materials. So that is a key area for transition for the synthetic rubber industry to work with the collaborators and their customers.
Roxanna?
Here, I'm sorry.
Yeah.
Just to add
any point? Yeah.
Here, to add that the transformation and mobility is due to the pandemic. Some of those trends will be delayed, but some of them they will be rushed through the next 5 years, I guess, especially for the electric vehicles with all the government support and incentives. So this is the time that we gotta be on board. We gotta react fast to be able to be part of this transformation.
Yeah. So I think it's great. Now we are starting to see some lights at the end of the tunnel that maybe will be brighter during the second half of next year, 2021, hopefully. And right now I would like to thank Tom, Ramon, Lekshmi, Roxanna, for the efforts that they put for Juan Ramos and Roxanna and Lekshmi in organizing this webinar, and for Tom for his great insights on the global economy. To all the participants, you will get the access of the recording of today's webinar, and on behalf of IRSG and IISRP, I would like to thank you for joining us, and Merry Christmas and good festive holidays that are coming, although for some of us will be under a kind of restriction or lockdown in place. But I think you should enjoy it anyway. So stay safe and healthy, and we look forward to seeing you next time. Thank you so much.
Thank you, everyone.
Thank you, everyone.
Thank you.
Happy
Stay
holidays.
safe.
Bye-bye.